We are thinking about China now more from a tactical perspective. Uh, it's hard to see the investment case for China years and years out. But certainly in the current situation, given the fact that the authorities are trying to stimulate, and given the fact that valuations are so inexpensive, we certainly think it's a tactical opportunity to buy China. But we would also say that you want diversification when you invest in China. 5 to 10 years ago, it was just about buying bats, Baidu, Alibaba, Tencent. Now we believe that you need a more diversified portfolio when you invest in China, given the higher levels of risk.
Can you offer us a bit more colour on where the sectors where that tactical opportunity lies, Aaron? Because if you are buying China selectively, is it in healthcare, is it in travel, is it in insurance, those sectors that have strong secular growth tailwinds associated with them?
Yeah, it's not just about the growth aspect. Certainly you get some of the growth from the internet platform stocks, but it's also about getting good and strong dividend yields, which you get admittedly from more of the old economy stocks. Our biggest overweight in China right now is to PetroChina, an energy stock. So we certainly like energy. So I'd highlight that. It's a mix, not just the higher growth stocks, but also higher dividend yielding stocks.
Does it surprise you that global markets that are hitched to China, whether it's through the MNCs like Apple, Boeing, Caterpillar, that make up quite a large percentage of the S&P, are not pricing in the malaise in China as much as they should do? And what is it that is ring fencing that spillover?
That's a great question. When I look at U.S. stocks, especially, and Apple's a great example, talk about the Magnificent Seven that you talked about before, they seem to be, in terms of going to the stratosphere, valuations are very rich for U.S. in general. And so investors seem to be glossing over the exposure of a lot of these stocks to China. And that's where we think the tactical opportunity lies, where EM today looks very cheap, basically a 40% discount to the U.S. And as you said, in the U.S., you still get exposure in a lot of these stocks to China. So why not buy the cheaper asset class today?